Hey guys, this is Rudy coming at you live from Florida. It is Thursday. It is January 16th. We're already halfway through January. Can you believe it? Anyway, the market's been doing its usual ups and downs. Just yesterday we had a great day, and the day before that, from an energy point of view, we had a bad day for no particular reason. No fundamentals changed. Nothing happened. It's just manipulation. Traders will trade, and that's just the way the market works. What I want to do today is something a little bit different to what I usually do. And let me just open this presentation here. And for starters, what I want to do is just say a formal, I mentioned bulldogs, MS State Bulldog in the previous video, but in this particular instance, I want to actually give a formal shout out, say thanks to bulldogs. You know, um, in the time a few years ago when I started making videos about Occidental Petroleum, I was recommending Occidental as a buy to many people who took advantage of that and purchased Occidental for, 10, 12, $15 or thereabouts, or otherwise traded in warrants. And some of them made an enormous amount of money, and I'm happy for them. And during that same time, Mississippi State Bulldog 83, said, hey, Mr. Oxy, you need to take a look at energy transfer. And I've said thanks to Bulldogs fan, the number one Bulldogs fan, a few times, but this is a formal thank you because it's turned out that energy transfer is almost like my Occidental part two, right? So I was able to get into energy transfer at about $8, and now it's trading at close to $20, and it pays a dividend of about 7%. It's a good deal. What I want to do today, though, as I said, is a little bit different. So RG Moreno wrote me. So this is on our channel's comment section, and you would have noticed by now, if you write a comment, there's a really good chance that I might respond. Or otherwise, if you just say something nice to me, I'll just give you a thumbs up or something. But at the end of the day, if you ask a question or get into discussion, there's a really good chance I might chat with you and respond in kind. Anyway, Mr. Moreno writes, everyone likes the successful trades in stocks, but not enough is said about the criteria for cutting a stock. And well, that's very, very true, right? And this is a hard decision-making process. I've sometimes had to get rid of stocks that went the wrong way, even though everything in me told me it was a good bet, but the stock market told me otherwise. And those are hard decisions, the hardest decisions for me, admitting I was wrong and correcting the trade. Well, sometimes you're not necessarily wrong. It's just that things happen that you can't predict or that are completely outside or beyond your control, right? At the end of the day, you can only control the controllable. But it's a true comment, right? So what Mr. Moreno is basically highlighting here for me is that all the time I talk about stocks when I make videos, and I talk about the stochastic score and the price earnings ratio and the quick ratio and the current ratio, and I compare the revenue to sales and the book value of the stock, etc., trying to figure out whether the stock is a good buy or not, right? Or otherwise, maybe it's just something you could put on your watch list and sort of tag along. But I don't really talk about selling a stock. So why don't we do that? So the question that I'm going to try and answer for you here is when to sell your stock. And what I've done is I've broken it down under 7 different headers, right? The first one is probably the most critical one, deteriorating fundamentals. When you have a situation where you see the company's earnings are declining, it could be for a whole variety of different reasons. It's your job or your duty as an investor to figure out why your fundamentals are changing, why your company that you bought, why are the fundamentals changing, right? Debt might be increasing. There are management issues. It could be a time to sell. For the sake of this example, I'm going to use Moderna, which I don't have a long position in. I've never had a long position in, but I'm going to use it as my example. How about significant market shifts? If the broader market conditions change drastically, and we're still staying with Moderna, then I'm going to talk a little bit about rebalancing, which I covered in the previous video. So I'm going to be quick and short on that one. And I'm going to recap on my energy and talk a little bit about concentrated positions. If the investment thesis changes, so this is number 4, maybe the initial reasons why you bought the stock has changed and they are no longer valid, right? So for that particular one, I'm going to use stock trading out of Canada. It's a small cap. It's Colonial Coal. You can buy it over the counter, CCARF, or you can buy it on the Toronto Stock Exchange, ticker symbol CAD. A large price drop So this is number 5. If a stock experiences a significant price decline due to concerning company news or changes in fundamentals, in addition to Colonial Coal, I'll also talk a little bit about or reference Moderna, but specifically, I'm going to start including Devon in the mix. And then I want to talk about reaching a particular profit margin. So this is number 6. You can sell a stock once it reaches your desired profit level. That's an easy one. And then cutting losses if the stock falls below a predetermined threshold, indicating a bad investment, you can limit your further losses. There are tools that you can use in order to assist you with that. I'll touch on them in just a minute. And for the sake of this example, I'm going to use Devon and Moderna. In other words, on this particular last one, the 7th one, cutting losses doesn't mean you have to take a loss at whatever it falls to, right? You could use a tool to say, I'm going to cap my loss at 3% or 5% or whatever the case might be. So let's talk about this one quickly, deteriorating fundamentals. And just to be clear, I'm not going to take a position here in terms of the pandemic, uh, the greatest scam, and multiple scams that were initiated through a variety of different politicians and pharmaceutical companies and things like that. I'm really just focusing on the stock. So whatever your beliefs and allegiances are in terms of your political affiliation or your trust in pharmaceutical companies or whatever, that's not what I want to discuss because I want to try and stay away from that. But we have deteriorating fundamentals, which drove the stock down on Moderna, for example, from $449 in September 2021 all the way down to $35 where it was trading yesterday when I took this screenshot. You could say to yourself, like, why the deteriorating fundamentals? What happened? So here's the at least one example, right? So published Monday, January the 13th. So just a couple of days ago, CNBC Business reported that Moderna lowered its 2025 sales guidance by roughly $1 billion. Now, the company expects revenue to only come in between 1.5 and 2.5 billion, right? So when you are making, let's just average that out and say $2 billion in revenue, because you cut your revenue target by $1 billion, you basically cut your revenue target by a third, right? So the fact that the stock plunged nearly 17% just on Monday is probably an indication for you that something is significantly amiss with your investment in Moderna. If you are long in Moderna, these are significant deteriorating fundamentals, and you probably should get out. Now, just to set the stage here, they flew high post-pandemic because a company, in this case Moderna, who had never had a product that they successfully brought to market before, just popped up out of the blue with a COVID-19 vaccine, which was going to arrest transmission and prevent you from getting sick. Well, that was the first deteriorating fundamental, except it happened over a period of time when we realized that perhaps maybe it's not as safe and effective as it should have been. And then we saw entities like the CDC changing the definition of a vaccine to say that it no longer arrests infection, but actually just helps you to not get very ill. And certainly if you go to hospital, you won't die, right? So they changed the definition. That was kind of step one of deteriorating fundamentals. And as a result of that, this is sort of step two, but this is not a good picture at all. Right. So let's go a little bit on a lighter note and talk about portfolio rebalancing. Now, this is an example of when you could potentially sell some stocks. Now, I talk about this from time to time. I've covered it in multiple videos, and there are a few things that I do from a personal point of view that you might do as well, that you could copy. And some of them I don't necessarily do, but I do sell incrementally. So I sell little bits of stock over time. Like, for instance, my Occidental Petroleum position, which was great in terms of being in the money, because my cost basis was so low. My cost basis was like average $10. So when Oxy was trading at $70 or $60 or whatever, I could sell Occidental Petroleum and bank some good profit along the way if I needed the cash because I wanted to reinvest the cash somewhere else. So sell in small tranches, like little bits of stock incrementally. You can use options or stop loss orders. There are two very common methodologies that we use here. One is called a covered call, and the other one's called a trailing stop. They have different names, but they sort of work in the same manner. So if you think of something like, let's say, Occidental Petroleum, if you put a trailing stop on Occidental Petroleum, and let's say, just for the sake of example, you bought it for $20 and you put a trailing stop against the stock of 10%, a stop loss sell order, right? So a trailing stop means that it's going to trail the price higher, 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 but as soon as it drops 10%, it's going to immediately execute and become a sell order, and you're going to exit your position, which, by the way, creates a tax event. But that's how these tools work, and they can help you to mitigate losses, because instead of buying Oxy and watching it go to $3, you can buy Oxy for $20 and put in a trailing stop loss at 3% or even 10%, 10% being $2. So if Oxy goes down to $18, you're going to sell out and just lose $2 per share. But conversely, the trailing stop or covered call allows you to ride the stock up. So if Oxy goes to $40, $50, $60, right, and then drops 10%. So using that example, let's say it goes to $50 and suddenly, because of a bad quarter, it drops 10%. So now it's trading at 45. Then you exit, but you only bought it for 20. So you're probably happy, right? You can also toggle between exchange traded funds. I do that all the time. I'll show you an example of that in just a minute. And you can gift appreciating stock. So I do that too, because my family and I own a charitable foundation. It's called Memory Trees. Memory Trees in the United States is a registered 501c3, which means it's a tax-exempt organization and a registered public charity. Now, what I've done here is I'm showing you gifting appreciated stock from a personal point of view to a charity, right? So the charity in this case is memorytrees.co. You can look it up on the web if you'd like. So in this example, which is a real example, I donated to the charity 300 shares of Occidental Petroleum, and I did that in December of 2023. Very specifically, over here on the right-hand side, you can see the date, which was December the 22nd, and Occidental was trading at around $60 per share. I donated 300 shares. Occidental was trading at $60 per share, approximately, which means I made a donation of $18,000, approximately. But my cost basis was approximately $10 per share, which means the cost of my donation was 300 shares multiplied by $10, which is $3,000. So effectively, I made a donation for $18,000, which only cost me $3,000. And in the United States, when you donate to a charity, you can deduct up to 50% of that donation against your adjusted gross income, or AGI. And in this particular example, I now have a $9,000 reduction in my taxable income that I can deduct from my taxable income, although the donation itself actually only cost me $3,000. Does that make sense? Right? So I get a 3x on my adjusted gain in terms of that donation. This is a snapshot of superior diversification, according to, on the left-hand side, yeah, I put their website, 712portfolio.com. It's a little bit overcomplicated for me, but the reason why I'm showing you this is because I actually like it from the point of view that it's a nice mix, right? So what they do is they say, these are engines and these are brakes, and here's they have a combination of large, mid-cap, and small stocks, some real estate, etc. And then on the brakes, they have bonds and cash. Now, of course, cash doesn't earn you much money. In fact, many people will tell you that cash is trash if you hold it in your account, because you're actually losing money every day due to inflation. But it is a break, right? So when the market suddenly crashes or tanks for whatever reason, your cash and your bonds or whatever are sort of somewhat protected. So what they have is engines for growth and brakes for downside protection. And you could probably diversify your portfolio as well using a similar example. In my energy portfolio, which I shared in the previous video, so I'm not going to spend too much time on this, I showed you an example of some rebalancing, excluding energy transfer. That's also one of the reasons why I started off with my thanks to Bulldogs, the Bulldogs fan, for energy transfer, right? So if you look on the left side of the ledger here, I basically have rebalanced 5 positions. So if I were to say, I'm going to take a little bit of money out of XLE, which is an ETF, and move some of that money into Exxon and Phillips 66, which has a smaller holding than ARLP, which is Alliance Resource Partners, or Enbridge, then these ones would be sort of balanced, right? So they're all kind of the same, right? So the pie chart is more or less the same. Even XLE is sort of similar, right? The smallest position is 11, the largest one's 15, so they're kind of the same. The odd one out here is energy transfer. Why do I keep energy transfer? Well, my cost base is about $8. It's currently trading at around almost $20. pays a dividend of 7%. So I just keep it, let it run. Everything's fine. There's no particular need for me to sell it, right? So I'm rebalanced, yes, maybe no, right? So you can rebalance to suit your own or to match your own requirements in terms of what it is that you're trying to achieve. But this gives you an example of how you can do it. How about if the investment thesis changes, right? So in this particular example, I'm going to use Colonial Coal. It's a small cap company out of Canada. Colonial coal is metallurgical coal, which is the coal that is used for making steel. In other words, it's not thermal coal, which is used typically for heating. And I've previously made two videos on Colonial Coal. The first one was an interview with David Austin, which is about 21 minutes. You can look in the library, you'll find it there. Poor audio quality, but you can make out what he says. And the next one I made sort of tongue in cheek, saying how to lose all your money with Colonial Coal. And that one's about 22 minutes. So if you're interested in Colonial Coal, which is metallurgical coal, you can watch these two videos. Why would you watch it at all? Because Colonial Coal has been for sale for almost 5 years. So let's talk a little bit about the investment thesis change here, right? So for 5 years, the company has been for sale. Starting out in 2019, originally they blamed the pandemic, and they said because of the 2020 pandemic, everything ground to a halt, and they couldn't make a sale, nothing happened. By 2021, they had three investment bankers on the case, right? So the three IBs that I mentioned down here. So out there selling the company, in addition to Mr. David Austin, who's the CEO, very, very good, fine gentleman, nice guy. I really like him. And so David Austin is out there selling the company, and he's got help from three guys, probably the most well known of the sort of guys helping him to try and sell the company is Canaccord Genuity. And then in 2024, not 2023, that's a typo, Citibank joined as well. So now you had like four investment bankers there. Mr. Austin already had more than 20 NDAs, non-disclosure agreements, executed by potential or with potential buyers. The shares spiked. So Colonial went all the way from when I first got my introduction in 2020, 2021, from about $1.50 or so up to about $3, and then $3.30, I think, was its high. And the share spiked. But now it's been 5 years and there's been no sales, good news, and no particular interest from any buyers, despite all these NDAs that have been signed and the fact that there are four investment bankers on it, including Citibank. There's been no action, right? So the investment thesis for me has changed somewhat. So I've actually exited my entire position. I exited it over time, right? So at the bottom here, I made a comment saying it's an OTC and it's illiquid. I owned Colonial Coal over the counter, which is CCARF, but I also owned it in Toronto, which is on the Venture Exchange, CAD, CAD. You can be tough with these small caps because they are illiquid. There's not enough volume traded, so you can't just dump your whole position because you'll just crash the stock. So what you do is you put in a limit order at a price that you're comfortable with and let it just execute over time, which is what I did, right? But I just want to very, very briefly explain the investment thesis, the original investment thesis to you. So Colonial Coal owns approximately 700 million tons of metallurgical coal, but it's in the ground. They have two permitted properties. One is Huguenot and the other one is Flatbed in British Columbia in Canada. So it's up for sale, right? 700 million tons. At the time I first met Mr. Austin, metallurgical coal was trading between $250 and $300 per ton on the spot price on the market. And let's assume, just for the sake of argument, a willing buyer was prepared to pay him $3 per ton for the metallurgical coal that's in the ground. I'm rounding here just to make my math really simple, right? So 700 million tons in the ground times $3 would be $2.1 billion. And again, rounding, just assume they had 210 million shares outstanding. 210 million divided into 2.1 billion would be $10 per share. So if I was able to buy Colonial Coal for $1 and the company was sold for $10 per share, I'd have a 10x. It's very, very tough to generate a 10x on any investment. Even one of my good investments like Occidental Petroleum, which I bought for like $10, got to $77, 7.7, not 10, right? It's tough to make a 10x on anything, let alone 20 or more, right? These things are most unusual. But the investment thesis has changed because there's been no buyers. It's been 5 years. So I'm quite happy to just exit and put the money in other, including high risk small cap stocks, but not Colonial Coal. Here's a graph in terms of illustrating what I just shared with you. So if you go back, you can see 2021, it's trading under $1, well under $1. It hit $2.40 Here I'm talking about CCARF, the over-the-counter stock, not the CAD, Canadian stock, right? So OTC on the US market here. It did $2.40 just 6 months ago, July 31st, and now it's at $1.20, right? So if you're down 50%, hopefully you didn't buy it at $2.40, because otherwise now you have a bit of a challenge, right? In terms of what you could do. You have three options. I'll come back to that when I talk about Devon in just a minute. But if you bought it at a lower price, like I did, you could just exit over time and say, okay, this has not worked out for me. The investment thesis has changed. I'm no longer confident the company will be sold. So exit the entire position. So RNG SFT, so my friend Russell, he wrote me a note here and he said, just curious, how long did it take you to earn that 100% increase in JP Morgan? This was also in relation to my previous video. You can watch that one too, because I referenced the sale on JP Morgan there. This is an easy one, right? It's really, really, really easy. Should have probably done it with Occidental Petroleum, right? Let's say I bought it for $1.20. When it hit $2.40, I'm up 100%. I should sell half of the stock, take all my own cash off the table, and let the rest do just whatever it does. Doesn't matter, because it's not my money. It's the house's money, right? Let's take a look at this one. JP Morgan, around about November 2020, opening position, $114 with reinvested dividends. Average cost basis around $1.20, 125, maybe $123 average after reinvested dividends. So let's call it 125 just to make it a round number, and it's currently trading at 250, right? So we're up 100%, reaching a profit target, right? So this is easy, easy. This is what I should have done with Colonial Coal. So, but I didn't. It's very difficult to time the market. Time in the market is better than trying to time the market, right? And don't be greedy. Like I was greedy with Colonial Coal. I should have just taken the 100%, sold half of the position and let the rest just run, which is exactly what I did here. So I sold 100 shares. This is in one account. I have JP Morgan in multiple accounts. I sold 130 shares, basically at 100% or more. You can see down there it says gain loss, and kept 130, right? So down there at the bottom, 126, sold 130, kept 130. So effectively sell half of the position. You take all your own money off the table. You can reinvest it into anything else, including JP Morgan if you want. But at the end of the day, everything I own now in JP Morgan is 100% paid for with the house's money. I didn't get lucky. I earned it. I took a risk because JP Morgan might have been Silicon Valley Bank or First Republic Bank and crashed and burned. You can't predict these things, right? But it is probably, arguably, America's best bank. So it wasn't that much of a risk. But still, I put my money at risk in order to buy JP Morgan. It went up 100%. I took my money back and left the house's money to just run. And that is a sweet deal any way you slice or dice it, because nobody gets poor taking a profit. So I went to bar chart and I looked at Devon Energy. Why is it underperforming the entire energy market? What is going on here? So cutting losses. So this article from December 2024, so just a couple of weeks ago, is written by Rashmi Kumari for Bar Chart. And he says, over the past 52 weeks, Devon stock has declined 33% and is down 32.6% on a year-to-date basis, significantly underperforming the XLE, which has dropped 2.2% over the past year and slightly down on a year-to-date basis. Now, here's the thing, right? So I bought Devon, and my cost basis was about $52, and then it went down into the $40, and I bought a little bit more, lowered my cost basis to about $48 or whatever. That's commonly also called trying to catch a falling knife, right? It just went down, 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 down. And somewhere along the line, you've got to say to yourself, like, I can hold this forever. Otherwise, I can just cut my losses. So I mentioned a minute ago, you have three options when something like this happens. You can either hold and just say, I'll just wait and see what happens. Eventually it will recover again, and it probably will, right? It's okay. But in the meantime, you have an opportunity cost loss, because if I had put the money into XLE instead of in Devon, I would have been down only 2.2% for 1 year. This is as of December 2024. I would have been down only 2.2% in XLE, but XLE also pays a dividend of 3.5, which means it's a wash, right? So I wouldn't have lost any money at all. But instead, I chose the single stock risk, which is Devon. And you can always say your single stock risk is as much of an opportunity as what it is a risk in terms of making money or losing money. Whereas XLE, on the other hand, is a much safer bet, but it's never going to give you the potential upside you can get from a single stock. But I work with CLE and I toggle between XLE and single stocks all the time. And in this, well, they always say, that's the benefit of hindsight, right? I could have just left the money that I put into Devon in XLE. It would have been fine, right? So I made a mistake, and effectively had to cut my losses and take some money out of the market there. The good news for me is I didn't buy Devon at $78. I did not buy Devon at $78 in 2022. Otherwise, it would have been significantly worse. What I did do was buy Devon originally at around $52, and then eventually my average cost basis was at around $48, and eventually I sold out of the position entirely at around $42. So I lost a bit, approximately 15%. But as I say, I could have just left the money in XLE and I would have been okay. But sometimes you just got to cut your losses. The interesting thing there is if you're sitting in a huge loss situation on your brokerage statement, you've already taken the loss anyway. So whether you sell it or not is just in terms of whether you actually want to pull the trigger or not. You have three options. You can either sit and wait and hope it recovers, or otherwise you can say, I'm going to buy a little bit more. And then by doing that, I'm going to lower my cost basis and then hope, of course, it goes up, but it would go down more, which is my example. Or otherwise you could say, I'm just going to cut my losses and sell out and get out of this position. I don't like taking a loss, and I'm going to wrap up with this in a minute, but I just want to show you in practice, right? So I always try never to take a loss unless I need a tax loss for personal tax purposes, right? So I'm going to show you a quick snapshot of four accounts. In this particular account here, I sold Devon at a loss of $5,000, but I also sold XLE for a profit of a similar amount. In this account here, I sold Devon, a couple of tranches, call it 3,000 something, $3,500 maybe. And I also sold SPY and VYM. You'll notice there's a common theme here: XLE, SPY, VYM. These are ETFs, right? My ETFs are my parking lots. That's where I put my cash. So if I sell out of Devon, I put the money back into XLE, for example. And when I put it back into XLE, it sits in the parking lot until I think I got something that's undervalued that I might buy. And like everybody else, sometimes I make a mistake and pick Devon instead of picking something else that might have gone up, like NVIDIA, right? Here's another example. 3,600, so $3,600 of Devon Energy sold, VYM XLE. See, it's sort of a common theme, about $3,600 or thereabout, positive as well. There's one exception here, Devon and SPY. So SPY again is the ETF. And then at the bottom, you see I also exited one of the banks. I liked TD Bank originally, but I like JP Morgan much more. So any money that I generated out of TD Bank went into JP Morgan as an example. But you can see some of these trades here. I have multiple accounts where I have the similar trade. I just don't like taking a loss. Now, why don't I like taking a loss? And this is my wrap-up slide here for you, because one of the smartest guys that we've ever met from an investing point of view, Warren Buffett from Berkshire Hathaway, says he only has two rules when it comes to investing. Rule number one is don't lose money. And rule number two is never forget rule number one. So guys, on that note, I'm going to leave you, and you can tell me what you think of my 7 examples of when to potentially sell your stock. And Mr. Moreno, I hope this was beneficial to you, and maybe, who knows, also to somebody else. And by the way, subscribe. Okay. Thank you for watching. Take care. Bye-bye.